Welcome to a CPA Australia webinar, sponsored by Wolters Kluwer. This webinar is titled Uniform Platform for CFOs, Value Creation and Transformation. My name is Gavin Ord and I'm the Senior Business Policy Manager at CPA Australia. We have people joining us from all over the world today for today's webinar, and I'd like to extend a welcome to everyone who's joining us today. I especially would like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. It's now my pleasure today to invite Daniel Vertel to present. Today, Daniel will be taking questions through our Q&A box. Please direct all questions to all panelists. Daniel will try to address the questions at the conclusion of his presentation, and we'll do our best with the time remaining to address all questions. For any troubleshooting queries, please send a message to the host using the chat box function. It's now time for our webinar to commence, so I'll hand over to Daniel to commence the presentation.
Thanks, Kevin. Just a quick introduction. I'm a business director with CCH Tagetik, responsible for new market entry in the Asia Pacific region. Been working in the finance technology space for over 15 years, focusing on financial system strategies, technology solution selection and implementation projects. Prior to joining CCH Tagetik, I worked with big four firms in Europe and Asia, providing advisory and regulatory services. So even before COVID, many finance executives were finding their existing tools, processes, and capabilities inadequate for the task. They were too slow, too cumbersome, and too inward focused. And when COVID-19 emerged, they simply were not set up to rapidly account for the many new internal and external drivers that had to be factored into their forecasts. I'm thinking about external variables that didn't even exist 2 years ago, such as movement restrictions, but have suddenly become indispensable for determining what COVID-19 means for their organization. So over the last 18 months, CFOs and their teams have learned much about their forecasting processes. In addition, their capabilities will have broadened and improved going through this baptism of fire. CFOs should now institutionalize what has been learned and permanently incorporate the improvements into their planning and forecasting processes. And high on the agenda should be taking advantage of technology to automate as much of the operation as possible, and not only to respond faster to future changes in the economic environment, but also to free finance teams to spend less time collecting data and more time responding to what it is telling them. So over the next hour, we're going to have a look at the trends and challenges that drive the modernization of finance, the increasing push for FP&A to take more account of the operational side of finance into what Gartner has termed extended planning and analysis. I will then give some pointers on how to get started with the XP&A journey, as well as how the role and skill set of finance will need to evolve in the future. And finally, we will have a look at some practical experiences from existing CCH Tagetik customers. COVID-19 has changed the dynamics of the finance function. The world is changing at a much faster pace, and finance is expected to react and answer immediately. In addition, finance is tasked with making high-stake decisions faster than ever. In many cases, CFOs are now expected to be much more strategic, providing insights and not just numbers. To support this shift, finance application must natively provide modeling and analytics capabilities and be capable of handling large amounts of data. They should empower the end user with more self-service reporting and analysis capabilities, while also maintaining financial control and the confidence of the CFO. With demands for increased transparency and confidence from stakeholders, planning must now expand to include more granular data into the processes, exploring planning and forecasting at greater detail and accuracy into the future. I'm thinking here about rolling forecasts, which are well beyond your normal 12 months horizon, 18 months and so on, and long range planning, strategic planning. You need to establish materiality thresholds with details used to trace issues, explain variances, or to establish trends. Planning also needs to include much more operational data from across the organization to drive value creation and to steer the business to improve operational and financial results. In their latest edition of the FP&A Magic Quadrant, Gartner stated that by 2024, 70% of all new FP&A projects will become extended planning and analysis projects, effectively extending the scope of FP&A beyond the finance domain into other areas of enterprise planning and analysis. So when we're looking at emerging technologies such as artificial intelligence, machine learning, and predictive analytics, they require the processing of high volumes of granular data. These technology advancements will have a big impact on the way of working in finance, leading to much higher level of automation and increased precision in planning and more accurate forecasts, as well as the speed of decision making. Many finance solutions already make some use of artificial intelligence, machine learning, and predictive analytics. And Gartner expects this trend to continue. So by 2024, again, 70% of new AI projects in the finance domain will already be out-of-the-box functionality. In addition, finance has to respond to expanding reporting demands. Financial, operational, non-financial, and regulatory reporting, they often require granular data from many sources to produce multiple outputs in many different formats. Just think about the discussion on sustainability reporting, which until fairly recently were not high on organizations' agenda. Finally, finance is expected to drive value creation. By integrating financial and non-financial data to find and report on the value hidden across the whole of the organization. So what are the challenges with traditional planning and forecasting? First of all, it's hard for finance to build up the plan. Finance processes are often based on disparate systems without a centralized location that can hold all the granular financial and operational data to mine for answers. It is slow to build budgets and plans as the process starts top down and then contributors are asked for bottom-up input. Generally, a business is hard to model. Mathematical models at the moment are often too simplistic with few drivers and they cannot accommodate all the assumptions. As a result, the effect of activities to reach a certain target cannot be assessed properly. And a lot of inconsistencies are usually hidden in the underlying data. In addition, there's often too much data to find outliers efficiently. On the other hand, an aggregated view used to reduce complexity tends to balance out the impact of detailed problems. So for many organizations looking back historically, the budget and plan is very far from actuals. Human bias, like overconfidence in sales, results in high variances between forecasting and actuals. In addition, there's limited learning potential about the drivers since the models are high level. If you try to introduce new drivers to improve accuracy, it's often difficult to know which drivers and how the drivers will impact the financial figures. Secondly, plans are often hard to explain. Revenue and costs mostly don't match. If you actually exclude direct cost, there's generally a poor interconnection between revenues and costs because planning is done in silos without consistency across the entire plan. And the planning process itself often relies on specific business experience. Only people with a deep knowledge of the business can play a role. And so it's not a scalable process. A budget is mostly as accurate as the level of business experts involved in the process. There's also a lack of insight since the drivers that most impact the results are often not known, and drivers which aren't accounted for when making predictions obviously limit the forecasting ability of the business. So generally, it is hard to simulate scenarios since most models are too simplistic, and we cannot easily simulate alternative scenarios or accommodate new information into the models. Finally, it is hard to act on the data. Plans often end up being inaccurate, and as a consequence, estimates need to be reworked several times. Plans contain a lack of guidance on how to improve. Once you have the plan, there is no answer to questions like, if I need to match a specific target, what should I change? There is a lack of collaboration and alignment with disparate systems, team collaboration, often done manually via emails or circulating spreadsheets. And this, of course, brings about a low level of alignment and increasing risk of miscommunication, errors, and overall inefficient process. When there is a disconnect between the operational planning and the financial planning, different parts of the organization may be working towards different goals. It's critical that all parts of the business are aligned and working towards the same targets. So this table should give you an overview that the misalignment issue is not only linked to data just sitting in different silos. Finance and operations are looking at planning differently, and aligning them also means aligning the planning approach itself. For example, the starting point for finance is usually top-down, while sales and operations will work from the bottom up. S&OP will mostly plan down to SKU level, but only look at the financial impact for revenue, cost of goods sold, and inventory. Finance, on the other hand, will want to know the impact to all financial statements, including whole of the P&L, balance sheet, and cash flow, but probably only down to product groups. In addition, if you think about the planning cycle and planning horizons, they're very different. Since finance concepts such as monthly reporting and closing of the books, as well as the financial year itself, have very little relevance for operational planning. So unless your plans, data, and processes are integrated and aligned in a single solution, there will be a lot of manual, time-consuming work needed for data collection and budget preparation. This leads to duplication of effort, data errors and data redundancy, extensive manual reconciliation, and so on. So without a centralized source for all data, from summary to detailed financial and operational data, not only is your data not deep enough for detailed planning and analysis, but when you make a change to any assumption, driver, or goal, you're not able to see the impact cascade throughout your organization. For example, if you change your production forecast, how will that impact your profitability, your cash flow, and your balance sheet? There's no visibility across the organization to see how a change in performance can impact your bottom line. Finally, without a unified platform for both finance and S&OP processes, it will be difficult to achieve the agility required and understand the drivers of performance throughout the organization. So I believe everyone is familiar with the Gartner Magic Quadrants. For any given product group, Gartner evaluates every solution in the market according to its ability to execute and the completeness of vision. The solutions are then plotted into 4 quadrants: niche players, challengers, visionaries, and leaders. So the Magic Quadrant for FP&A, for example, is often used by companies to drive the selection process for their next FP&A solution. And Gartner has recently identified the emerging trend of extended planning and analysis, coining the term XP&A, and sees it as an important market driver of the future. So by 2024, Gartner expects FP&A to largely evolve towards XP&A, where the X denotes the breaking down of traditional silos between enterprise financial and operational planning processes in order to deliver new levels of transformative business value. So according to Gartner research, we can expect that by 2024, 70% of new FP&A projects will be extended planning and analysis projects. So the aim of XP&A is to align the strategic planning, financial planning, Sales and operations planning, that includes the demand, supply chain, and production planning, as well as workforce planning and capital planning into a unified planning operating model. Looking at the organization holistically will improve the understanding of the key business drivers, not just for the financial planning team, but across all functions. And finally, understanding the business drivers and how they affect the financial and operating platform will lead to improved business decision, as the cause and effect relationships between can clearly be modeled and simulated. So from a solution perspective, the aim of XP&A is to provide finance and operation teams a unified platform to integrate processes and data for the detailed plans for strategy, finance, S&OP, workforce, and CapEx. So while XP&A is not an entirely new concept, and most organizations would have looked at a closer alignment between finance and operation plans in their 10-year vision. In reality, from my own experience, most FP&A projects are either a one-to-one replacement of an existing FP&A legacy solution with some process enhancements, mostly taking advantage of cloud hosting, better user experience, and more automation, or replacement of the core financial planning solution with additional operations-focused models, such as workforce planning and CapEx, which have been moved from spreadsheets into an integrated software. However, even today, FP&A projects are often still a replacement of a spreadsheet model, especially in small and medium-sized organizations. So the thought of 70% XP&A penetration, so combining finance and all operational aspects by 2024, would have seemed far-fetched to our 2019 selves. Pre-COVID, most organizations operated in a fairly stable environment where historic performance was a pretty good proxy for future performance. And with the emergence of COVID-19, this all changed. Suddenly, external factors became the key drivers, and the conditions were changing week by week or even daily. Finance and operations teams had to start collaborating much more closely, coming up often with complex Excel models only to discard them in the following week. They would have taken into consideration for the first time things like infection rates, mobility restrictions, developments in countries ahead of the curve, supply chain bottlenecks and alternative sources, shipping interruptions and spiraling costs, workforce availability due to lockdowns or them moving to other industries, or in the case of Brexit, and just moving out of the country. Some businesses would have had to evaluate mothballing of projects, plans, and reassessing future needs. So if we ask again in 2021, this 70% XP&A estimate by Gartner does no longer seem so far-fetched, although the new normal with an endemic COVID will be more manageable in the future. Increased uncertainty and the importance of organization-wide models based on internal and external drivers are here to stay. Today's finance function can no longer be the traditional reporting of old. Finance has to be better and more agile as a business partner and deliver value across multiple parameters, including producing the normal statutory and management reporting correctly, but first time and on time, optimizing the balance sheet, income statement, cash flow, and ensuring that the risk and commercials are in balance, providing insurance around the financial control of the business, and also providing insightful management information that is able to drive improved profitability and supports the identification of growth aspects. So XP&A requires the organization to look forwards as well as backwards, and having the right framework in place is a starting point. The business at all levels need to start reporting against the longer term strategic horizon, as opposed to a typical in-year performance reporting with some strat plan 5 years overlaid. So for many organizations, this means a mind shift in giving an honest view of expected future performance, with dialogue focused on actions required now to course correct on delivering performance outcomes in the medium term. The implementation of rolling forecasts is therefore key to understanding the future direction, along with the adoption of a greater collaborative culture between business units and the group. In addition, driver-based planning and value driver analysis help to develop clearly defined linkages between strategy, plan, forecast, and actuals across the functions. Finance in most organizations already sits at the heart and also collaborates widely across the business. I'm thinking of collaboration with channels and functions such as budget management, investment monitoring and decision support, value management of commercials, what-if analysis, and scenario planning. Finance is already collaborating with supply chain as well, usually through investment appraisals, P&L responsibility, maintenance and production reporting, as well as labor analytics. They're collaborating with marketing to some extent through new product and brand profitability analysis. And in addition, finance already drives value management and strategic projects through business cases, validations, and managing the consistency of transformation projects. However, for most organizations, this collaboration will often be ad hoc. And the effort required by finance to perform data enrichment and data manipulation has a large effect on the speed and impact of the process. So having a standardized data set will have to remove much of the time spent getting data into the models and ready for analysis. So in a nutshell, what are the potential benefits of XP&A? It's bringing strategy together with planning. It gives a real focus to finance and the wider organization. It helps create a single integrated business plan. It focuses on what drives the business and what moves the dial on performance. And at the same time, it enables visibility of performance with KPI-based reporting. It bridges the strategic, operational, and financial plans for a consistent and aligned approach. Extracting the annual plan from a well-run rolling forecast process, for example, it's not only more efficient, but also helps to align an annual strategic reflection point with the more operational views and trend analysis. In addition, unified platforms such as CCH Tagetik provide an efficient and collaborative tool to support a simpler process. So taking on an integrated plan requires a good understanding of key drivers and how they work. Starting from a basic strategic goal, such as increase in retail margins, and analyzing the drivers that support this. This gives a level of clarity and engages the wider business in relevant terms. Aligning the strategic, operational, financial, and capital planning into a unified operating model, it allows for informed, holistic decision-making and collaboration across the function. If you think about a traditional 2 to 3 month planning cycle, that leaves very little time for analytics. Also, continued uncertainty and market pressure is driving an increase in the amount of scenario planning which is required. That's a given. And only coupled with enhancements in predictive analytics can the planning process become a tool on which regular business decisions can be based on. So let's have a look at the 4 typical levels of analytics which could be expected to be deployed as part of an XP&A solution. First of all, the descriptive analytics looks at the what happened. It helps the understanding and the analysis of current conditions. The supporting technologies are usually focused on data management, such as a unified platform with standardized data definitions and hierarchies, master data management, as well as automated reconciliation and audit trails. On the next level, you have diagnostic analytics, which looks at the why did it happen. While still backward looking, the diagnostic analytics help to understand the drivers of historic outcomes. Supporting technologies here are mostly analysis and BI tools such as what if and scenario analysis, self-service, integrated drill downs, and dashboarding. Predictive analytics looks at what will happen. While most closely associated with XP&A, predictive analytics enables analytical modeling to understand potential ranges of outcome based on historical data. Supporting technologies driver include driver analysis and modeling, demand planning and forecasting, which will be driver based and include external factors. And finally, at the most advanced cutting edge, we have prescriptive analytics, which looks at how can we make it happen. This is focused on optimizing decision support by insight-focused technologies such as predictive and prescriptive modeling, self-learning algorithms, and scenario simulations. So in this regard, the CCH Tagetik platform is unique because it's actually offering a full set of predictive models out of the box for your end-to-end planning. It provides pre-built predictive models that cover 80% of planning needs in typical organizations. It includes an integrated platform, the Analytical Information Hub, which can supply granular data with a powerful processing engine. You can actually have it run on in-memory engines such as SAP HANA. CCH Tagetik has also true machine learning embedded. The models are trained using machine learning and the customer's own data. Learning algorithms are able to adapt the results, to improve consistency checks for the subsequent planning, and so on. CCH Tagetik also allows you to import your own pre-built predictive Python models. Of course, advanced analytics is never plug and play. I don't think any solution really is. And there's several points to consider when moving to advanced analytics. First of all, the models require structured data within well-defined parameters. And depending on the complexity of your business and your models, you may need access to large amount of accurate historical data to model and code. And it's actually no coincidence that the financial service industry has the highest adoption of advanced analytics because of their tightly controlled core system and mature data warehouse structures already used for regulatory and management reporting. They have large pools of accurate data already at their fingertips. Another consideration may be the ongoing manual effort required to train systems, maintain rules and external links, since it's unlikely models can be static over multiple planning cycles. And of course, analysis provided by XP&A still must be reviewed for reasonableness, and the data sources must be reliable and secure. Now, how to get started on the XP&A journey? First of all, I would say just start small and fail fast and discover what works and what doesn't. For most organizations, XP&A will be a discovery journey where established processes may not be the most suitable for a collaborative world. Therefore, a big waterfall approach you often see with ERP systems or early EPM system to implement, it probably will be very hard to manage. The second key point is to focus on change management. Value is largely driven by people and data, not processes and technology. Especially for organizations used to working within well-established silos, breaking the status quo and moving towards a collaborative platform may require significant change management effort. In some cases, the experience of the last 18 months may have already broken down some of these barriers. Since for many organizations, a much more collaborative, cross-functional way of working was required to respond to the uncertainty. Other points to consider is to develop a vision and process for XP&A. You should be looking at integrating your processes to understand data dependencies and ensure continuity of your information. Finance is best suited as a facilitator to drive cross-functional collaboration and ensure forecasts for sales, operations, and financials are fully linked. Finance team need to shift their focus from data aggregation and report building to analytic focused activities. You will need to look at internal and external business drivers and how they affect key KPIs. In addition, establishing a rolling forecast that integrates both finance and operations with the right level of detail and aligning the rolling forecast to your business cycle, for example, 18 months instead of the financial year and year to go, will give you a big advantage. You should look at leveraging a unified platform to improve collaboration, agility, visualization, speed, analysis, and access to data. To ensure consistency, establish common governance across the framework. For example, common tools, data models, definitions, and standards. Finally, reduce the complexity, the level of detail, and establish materiality thresholds. The focus should be on the KPIs that matter and drivers that make a difference. As part of the journey to XP&A, you will also need to take a fresh look at the data sources for internal and external business drivers. In this table, as an example, you should consider not only how useful the information is at the moment, but also how useful the drivers could be in the future. And of course, how much processing effort is involved, especially for external drivers. It's useful to develop a driver's map and think about if and how these value drivers could affect your KPIs or strategic goals. You probably only use a small subset of that driver's map, and you will reflect them in your models, but you should think about categories such as macroeconomic data, such as disposable personal incomes, GDP growth, interest rate, financial markets with drivers like bond prices, bond yields, employment data such as unemployment rate, job postings, supply chain drivers like commodity drivers, prices, supplier information, shipping rates, or depending on your industry, consumer-focused drivers such as foot traffic trends, same-store sales, online versus brick-and-mortar trends. And depending on the industry, again, if you could consider energy trends, weather cycles, seasonality, holidays, any other events which have any kind of impact on your business. Last but not least, as part of the new normal, think about COVID-related drivers such as movement restrictions, daily infections, ICU load, and government support schemes, and if they have any relevance for your business going forward. You will need to assess which of these drivers have a meaningful impact on your models. However, the most useful driver has little real-life value if you're not able to source and process it within reasonable effort. In any case, finance will need to adapt to become much more performance-centric and technology-enabled, and that demands a shift in the skill set required. So when contrasting the role of traditional FP&A against the future state of enterprise planning, I like to think of a pyramid where most of the current effort of the team goes into consolidation of data from multiple sources, data manipulation, reconciliation, as well as updating reports. So that's the big base of your current pyramid. And because of this, a much smaller amount of effort is available for analysis. And finally, at the top of the pyramid is the presentation and storytelling, which, to be honest, only often consists of a roll forward PowerPoint with updated commentary. In the future, this pyramid will be inverted. It will basically stand on its head, where thanks to unified platforms such as CCH Tagetik, a lot of data consolidation and reconciliation effort can now be automated. This frees up capacity for analysis, scenario simulations, and the creation of driver-based planning models. The biggest change, however, will come at the top of the pyramid, where the CFO and his team will need to take on a much more strategic role to drive value and overall business performance, not just by presenting the numbers, but telling the story and providing guidance. Most finance teams will see their role at the moment somewhere between scorekeeper and performance driver. XP&A, in a sense, is an enabler to allow finance to become a true business partner. Solutions such as CCH Tagetik can help them to quickly unlock value from data through scenario planning and rapid modeling, as well as leverage predictive analytics to understand internal and external signals that drive their business and enable additional insights and accuracy. So the skills required by the finance team of tomorrow, they're rarely 100% compatible with those of today. Whilst financial reporting skills will obviously always be needed, there will be a new focus on problem solving and relationship management skills. Successful finance teams will need to have both a core finance technical expertise, as well as a softer influencing, negotiating, and challenging skills. The following skill sets will be essential for future finance teams. They will need data science skills, such as data modeling, analytics, and visualization, strategic trend analysis, design thinking, and programming expertise, such as Python, especially where complex operational models are required. You also need influencers with a focus on soft skills, such as strategic thinking, impactful storytelling, feedback, communication, negotiation skills, relationship management, and program management capabilities. Finally, you need a business architect who possesses a thorough understanding of all aspects of the organizations and can drive the business modeling, the financial driver analysis, and the process design. In the future, the majority of the finance workforce will be focused on decision support. The key areas are partnering and insight, modeling, and advisory. So now let's have a look at the first case study here. Having worked in the automotive industry myself, let me give you some brief background on the industry-specific requirements. So product development cycles are usually quite long. So when a new model is released, the replacement model, which will come out in 6 to 8 years, is already quite advanced in its development. Due to the capital-intensive nature of the industry, the planning horizon is usually very long. Profitability is calculated down to individual VIN numbers. So for the non-petrol heads, this is down to every single car produced through advanced cost allocations. Budgeting, planning, and simulations are performed across many projects, combining production, margin, and sales planning, as well as detailed workforce and cost planning. So Daimler is a long-term CCH Tagetik customer, using Tagetik for different planning and consolidation processes across the divisions. Daimler also uses SAP and Microsoft technology as a corporate standard for their BI and CPM solutions. So currently about 15 applications based on Tagetik are in use at Daimler. They're solving different requirements in the divisions. Within Daimler Trucks, for example, SAP HANA is the preferred technology for BI and CPM solutions. For the new global project planning system for Daimler Trucks, the support of SAP HANA was defined as a technological requirement. And just for context, when I'm talking about SAP HANA here, this is the database.ts for HANA ERP or BW for HANA, P for HANA. And this database can be used as the platform for Tagetik, same way as an Oracle or a SQL database can be used. The only advantage of SAP HANA is integration is much easier with other SAP products, and it is in memory. So the processing and calculation speed is much higher than your traditional Oracle and SQL databases. So for the new global project planning system, the solution should be used in different locations, in different continents and time zones. And the aim was to provide a corporate standard calculation and planning process. Basically giving the Daimler board a solid base for decisions about further developments of projects or dropping initiatives. So specific requirements were a multi-year planning approach with a 30-year planning horizon where the top financial figures are calculated, such as EBITDA, return on sales, turnover, etc. Every KPI should be calculated at product, region, and year level. The solution should enable the full simulation of project costs and also have the ability to manage complex allocation rules on granular data with a good performance. Finally, the solution, as always, should be easy to implement and maintain. So the implementation itself followed 3 phases. Phase 1 started with a feasibility study and with a prototype built in workshops in Asia Pacific, North America, and Europe. CCH Tagetik's flexibility and functional richness was essential for this approach. And after the buy-in from all regions for the CCH Tagetik platform and calculation schemes, phase 2 was started to deliver a centralized CCH Tagetik application with worldwide access based on SAP HANA. In the third phase, a dashboard built with Power BI on top of calculation views, enhanced with simulation capabilities to be used as a decision support application at board level was introduced. Overall, the system is highly accepted, and I think this is number 16 now in the whole Daimler environment. It's highly accepted, and the harmonized calculation methods and sensitivity analysis allows them a much better decision-making process. In the second case study, we're looking at Driscoll's. So they are the world's largest berry company, controlling roughly 1/3 of the $6 billion US berry market. Driscoll's management reporting is fluid and constantly changing. Driscoll's financial reporting group was in need of a robust, easy to use financial reporting tool, which they could administer and control themselves. A particular challenge was that the nursery operations had data in multiple systems without the ability to report across all systems. So challenges for the customers were Driscoll's were looking for a solution allowing them to have instant information for making decisions and enabling them to investigate all the details behind the costs. Differentiators for Tagetik were the ability to drill down and drill through. Easy reporting integrated into the solution, control of the process, and the ability to process big amounts of data through the analytic information hub without IT dependency, and the ability to get and use information coming from different ERP systems. Notable achievements of the projects were the reduction of time to develop accurate costing information by 50%. We introduced quick data refreshes. So now the data is refreshed every hour, 7 days a week. And the total data refresh time is under 10 minutes, therefore allowing them to dedicate much more time to value-added analysis. Again, the implementation followed 3 phases. Phase 1 included consolidating all data sources into AIH, the Tagetik Unified Platform, providing full financial statements at every entity and consolidated levels, hourly automated data loads from different data sources through the Tagetik standard ETL. Disclosure preparations were included, as well as fixed and variable reporting and analysis. In phase 2, we added then detailed cost allocations and analysis, as well as their bridge reporting. And finally, in the third phase, we added local statutory reporting for Europe, which was an additional 6 COAs, and nursery projects analytics through the analytical workspace which provides unlimited dimensionality. So looking specifically at the nursery reporting, why was the analytical workspace in Tagetik such a game changer? Nursery operations at Driscoll manages and monitors approximately 2,000 projects. the monthly crop statements are produced for each nursery location by project. And nursery projects are also unique to each nursery operation. In addition, the transactional details are unique to each nursery operation, requiring a very large amount of dimensions for analysis. Through the analytical workspace in AIH Tagetik, we were able to provide a consistent reporting experience across all finance-related analysis and across all of the nursery reporting for the first time for Driscoll's. So what's the outcome for Driscoll's? Finance now has full control over application and design. They are basically running the maintenance all within the finance team. There is very limited IT involvement. And they also gained the ability to implement special management-driven allocations with ease and report both with and without these adjustments. So this brings me to the end of the core webinar content. Lauren, I would like to open the floor for questions if there are any.
Thanks, Daniel. So if people are struggling to put the question in the Q&A box, please enter it into the chat box. I did have a few questions myself. Obviously, data is critical to this. The quantity and the quality of that data is very critical to this. What are some of the ways that businesses could best collect usable data and also have that appropriate levels of governance over that data so that you can produce some quality actionable information?
Yeah, so Tagetik systems, for example, are all based on a unified platform, which is, it's called AIH, the Analytic Information Hub. And basically what this does is similar to a data warehouse to some extent, but it's integrated. You can bring all the necessary data sources together. And that what AIH allows you is to bring this data together, not just what normal CPMs systems have a fairly restricted dimensionality because it's focused on financial reporting. But when you bring raw data in, you may want to look at much more dimensionality for drill down and for reporting and analysis needs. So we are bringing in this data without restrictions for any dimensionality. And then this data comes in a controlled process through standard ETLs. There are processes around it. You can include automated reconciliation and checkpoints within the process. And that data then, when it's used for financial reporting, where you need much stricter account-based, usually dimensionality, that rolls up it automatically through mapping from that analytical workspace into a financial workspace. And in contrast to other systems where you basically still different solutions and you need to orchestrate your process across different solutions, to getting this in one united platform, basically. So the processes are controlled in that actually it's the data hitting your landing zone and your ETL all the way to reporting. You can include, so it's sort of an end-to-end process which really enables the control data and getting the data aligned.
Thanks, Amy. I think you sort of broke up there a little bit. Yeah.
Oh.
So you sort of broke up there a little bit, Daniel. So maybe turn off your camera for the time being. Just another question is I can hear you, yes. Another question, well, sort of related to that is when you're looking at some of your clients, what are some of the more interesting data sources they're starting to bring into your software product that you think, oh, other businesses could learn from some of those data sources?
Actually, we are still in the early stages, but what we've seen client looking a lot more is external drivers, especially some clients were doing this well before COVID, but most clients realistically, when you look at FP&A, they would have brought in only the core financial data from the ERP, maybe a bit of HR data through workforce planning. But what we see now is a lot more external data being recognized. So we have retailers which are looking a lot more specific at point of sales data, especially with the shift from sort of brick and mortar to online, which was accelerated in a lot of the markets. Traditional department stores, they were starting to look a lot more at online, and they needed to track this kind of information because it was the first time they were doing that. They were actually building up models as they were going along. They were rolling out their online capabilities, their online product offerings, and at the same time they were looking at data coming back from those online sales and versus brick and mortar, and they started to build their models sort of in a very proactive way during that time frame. So most customers which had to look at external factors because it's affecting them in a very direct way, they would have spent already a lot of effort during the last 18 months trying to figure out how their system works. Unfortunately, not everybody was on a platform to allow that to do that, but we've done it with several customers of ours. So the unified platform is quite open. As I said, it's unlimited dimensionality. So quite often we see point of sales data coming in where there are regional restrictions in mobility. We've also seen this reflected in the models. But I think most organizations are still at a very early stage in that. I know of some train companies in Europe. They're actually now looking more in part of the sustainability and CO, carbon monoxide pollution. They start to look at weather patterns and so on to sort of try to forecast the CO level and what effect certain weather patterns have on the train line. So these are very new kind of areas, which at the moment are not directly related to finance, if you think about it. But with discussion of IFRS sustainability reporting, that may actually be something which comes eventually into the realm of finance.
Yeah, that's very interesting, Daniel. And another question here is, have you seen that COVID-19 has made a difference to how planning teams are looking at their processes?
So when you think about planning processes, so from my experience, there are basically three common ways of a planning process. First of all, finance does the overall planning. Ask each department to submit a fixed planning template, often based on Excel, and being emailed around. Or finance could own the planning process and requiring departments to input their own plans into the system. Thirdly, and that's the planning way we want to get to, is each department uses one common connected platform for their individual plans. So for many entities which were stuck with inflexible planning systems, it was a bit of a nightmare scenario when COVID suddenly changed multiple forecast factors at the same time, ranging from HR, supply chain, and other operational factors. The disconnected data in departmental silos gave them very limited visibility across the business. And they spent more time collecting the data than being able to analyze it. And they probably burned the midnight oil just making sense of it. However, we do have some FP&A teams which already have access to real-time enterprise-wide data sets. And they were able to understand patterns and develop multiple scenarios using predictive models. This gives them a much deeper, faster, more actionable insights, and also operationally connected plans and better risk and opportunity management. So if you look at it, disconnected finance and operational systems have quite often led to disconnected and siloed business processes. And that has made the business processes rigid and difficult to change. And I truly believe that for many finance teams, it has become clear over the last 18 months that the old ways of working are not sustainable. I don't think anybody is going back to how they were looking at their numbers, how they were planning, how they were imagining their solution 2 years ago. I don't think anybody will ever think this is an acceptable solution anymore.
Yeah, I would agree. I don't see people going back, and I don't see. One thing we're definitely seeing is staff also requiring flexibility. So we talk about great resignation and things like that. So
Yeah.
staff are behaving differently as well, and that obviously has to be reflected in some of the planning processes. And another question is that often comes up from members is cloud versus on-premises, so servers. Many software providers have shifted to cloud-only strategies. Should we therefore start to exclude on-premise as an option completely for our financial planning and analysis work?
So when the pandemic hit, cloud adoption moved into high gear, and that's not just for FP&A solutions. That basically anything cloud was rolled out new. I've never used so much Team in my life before. Suddenly, many employees were working from home, and that required access. Everybody to have access to applications and data that previously may have been housed in corporate data centers that require on-site IT personnel to run. So cloud was seen as a major disruption a few years ago, and particularly in the context of its potential risks. But today, most people in the organization appreciate it, given their need to operate remotely. The other factor is increased agility with cloud, which cloud can offer. It's much easier to scale up or down and bring new functionality into the mix. However, at least for CCH Tagetik, cloud adoption is not universal across the world. So we actually offer the same functionality for both on-premise and cloud versions of the platform with a very easy migration path because everything is exactly the same. So many customers in Europe, which is generally a little bit more conservative, particularly in Italy and Germany, they still prefer to choose on-premise for new FP&A. But they do this knowing they can easily move their whole application to the cloud when they feel ready. Other markets, such as North America, they're pretty much 100% cloud for new implementations. I haven't seen anything in the last year coming through which was actually on-premise. So many IT departments, they still prefer their solution nicely tucked away behind a corporate firewall and VPN. However, with the emergence of zero trust networks and such as Zscaler, it matters less and less where the applications are hosted. So I think cloud is definitely, we have seen an enormous rise, but we are not pushing anybody towards cloud. It's everybody's own decision if they want to do it now or later or not at all.
Thanks, Daniel. Well, I think that's it for our hour. Maybe, Daniel, if you can move to the last slide because it has your contact details. So, look, just want to thank you, Daniel, for an excellent and very interesting presentation, and also Wolters Kluwer for sponsoring this webinar. I'd now like to hand back to Lauren to conclude today's webinar.
Amazing. Thank you, Daniel and Gavin, and thank you to everyone for your participation. In the next 3 working days, you'll receive an evaluation survey accompanied by the recording of this webinar. We really appreciate your feedback, as it's extremely valuable to CPA Australia to deliver better events for you. Thanks again, and we look forward to welcoming you to another CPA Australia webinar soon.